Credit derivative is a financial instrument that allow investors to manage and transfer credit risk without transferring the ownership of debt instruments. These derivatives are typically used in the financial markets to hedge against the risk of default on loans or other forms of credit. Credit derivatives are traded over the counter, which means they are not standardized and are negotiated between the parties involved. The price of a credit derivative depends on the creditworthiness of the borrower and the probability of a credit event such as a default, bankruptcy, or downgrade. Credit derivative divided into two types, which are credit default swaps (CDS) and collateralized debt obligations or CDO. CDS is the most common type of credit derivative. In a CDS, one party pays a premium to another party in exchange for protections against a credit event such as default, bankruptcy, or failure to meet debt obligations, while CDOs are structured finance products that package various debt securities, including bonds and loans, into tranches with different levels of risk. Investors can buy or sell these tranches based on their risk appetite. We are moving on to how the credit derivative work. Here are two scenarios that illustrate the use of credit default swaps or CDS and collateralized debt obligations or CDO. As for the CDS, imagine you lend the money to a company and are concerned they might not be able to pay it back. Then you buy a CDS from another party, like buying insurance. If the company runs into trouble, the CDS seller helps cover your losses. By buying a CDS, you can protect yourself from the possibility of losing money if the borrower defaults, while the CDS seller agrees to take on the risk in exchange for a fee. As for the CDO, suppose a financial institution bundles mortgage from different people into a CDO. Investors can choose to invest in safer slices or known as senior tranches or risky ones, equity tranches, based on how much risk they are willing to take. The tranches are then sold to investors who receive the cash flows from the underlying debt instruments. The senior tranches have the lowest risk and the lowest return, while the equity tranches have the highest risk and the highest return. Last, I will explain the counterparty risk and the basic risk in a credit derivative. Counterparty risk is the risk that one of the parties involved in a credit derivative contract fails to fulfill its obligation, such as making payment or delivering asset. For example, if a bank buys a credit default swap (CDS) from an insurance company to hedge its exposure to a corporate bond, the bank faces the risk that the insurance company will not pay the bank if the bond defaults. Secondly, the basis risk is the risk that the credit derivative does not perfectly match the underlying credit exposure, resulting in a mismatch between the expected and actual cash flow. For instance, if the recovery rate of the credit derivative differs from the actual credit event or recovery rate of the underlying entity, this may lead to underhedging or overhedging of the credit risk.
So we move on to the credit default swap. So first of all, we are going to definition of credit default swap. So what is credit default swap? So credit default swap known as a CDS. So CDS is a financial swap agreement between two counterparties. So for example, investor making loan from the bank, bond, and insurance. So mostly investor go through the CDS to gain the benefit from the contract. Let's move on to the second part of this topic, which is how credit default swap is work. So there are four credit default swap works. So for the first one is risk transfer, the second one is protection against defaults, third one is premium payments, and the last one is credit event. So we will go one by one. So the first of all is risk transfer. So what is mean by risk transfer? So a lender who is worried about a borrower defaulting on a loan often uses a CDS offset or swap that the risk. So the buyer of a CDS makes periodic payments to the seller until the credit's maturity dates. So the second one is protection against default. So in the agreements, the seller commits that if the debt issuer defaults, the seller will pay the buyer all the premiums and interest that would be paid up the date of the maturity. So the third one is premium payments. So what this mean by the premium payments? In a credit default swap contract, the buyer pays an ongoing premium similar to the payments on an insurance policy. So the CDS buyer pays the CDS seller until the contract maturity date. So this part is same as a risk transfer. So the last one is credit event. So the credit event is in return, the CDS seller agrees that it will pay the CDS buyer the security value as well as an interest payment that will have been paid between in that time and the maturity date if there is a credit event. So we move on the last part of this topic, which is risk of the credit default swap. So one of the risks of a credit default swap is that the buyer may default on the contract, thereby denying the seller the expected revenue. So it means the seller transfer the CDS to another party as a form of protection against risk, but it may lead to default and loss, whereby the original buyer drops out of the agreement. The seller may be forced to sell a new CDS to a third party to recoup the initial investment. So in this part also, in this case, this may lead to the loss. So the second one is the jump to jump risk. So the seller may be collecting monthly premiums from the new buyer with the hopes that the original buyer will pay as agreed. So a default on the part of the buyer creates an immediate obligation on the seller to pay the millions or billions owed to protection buyers. So this means the seller must pay to the buyer to such a for a fines. So that's all from me. Thank you.
Let's move on to what is CFD. So CFD is stand for Contract for Difference. It's a financial arrangement used in derivative tradings. So it allows investor to speculate on the short-term price movement of various assets without owning them. Unlike the traditional investments, there is no physical delivery of goods or securities with CFD. Next, let's move on to how does the CFD work. So imagine if you want to bet on whether the price of a stock, currency, or commodity will go up or down. If you expect the price to go up, you buy the CFD. If you anticipate a price drop, you sell a CFD. When you close your position, there is difference between the purchase price and sales price determines your gain or loss. So CFD are cash settles, meaning no actual asset change hands. Only the difference in value matters. Next, let's move on to type of CFD. So basically, we have four types, which is stock, commodity, forex, and also index. For the stock, we can speculate on the individual company stocks like Apple or Google's. And for the commodity, we can bet on the commodities like gold or oil. For the forex, we can trade currency pairs like Euro USD or GBP JPY. And last but not least, for index, we can track stock index like S&P 500 or FTSE 100. And last but not least, why we use CFD? So basically, CFD is offer leverage, which allows to control a larger position with a smaller investment. But they are popular for short-term trading due to flexibility and also liquidity. However, be aware that CFD are high risk and not allowed in all countries. I think that all from us. Thank you for listening.